Hello and welcome to Hardman Talks. I'm Larissa Adams and I'm with Hardman Co's renewable analyst, Nigel Hawkins. Nigel, great to see you. How have you been?
Fine, thank you very much. We've had some interesting times in the sector.
Oh, wonderful. Okay, right. Can't wait to hear everything. So, Nigel has just released a piece in Hardman Co's February monthly notes where he takes a close look at infrastructure investment companies and renewable energy infrastructure funds, and in particular, the growing issue of wide discounts to NAVs. So, after a challenging 2025 for the sector, Nigel explores what's been driving performance, how investors have responded, and whether conditions could begin to improve from here. So, it's just a little bit of a background. So, I think let's just dive right into it. So, Nigel, was 2025 a good or a bad year for the IIC and REIF investment trusts?
On the whole, a poor year, particularly for the renewable energy funds, and the reduction of various adjustments is somewhere around 17% of their value. That's a pretty poor return. By contrast, the FTSE 100 was up by over 20% during the year, and the investment companies, the larger ones, held their own. They didn't do spectacularly well, but at least held their own, whereas the renewable energy funds plunged.
Okay. And given the government's support for renewable energy, why are the reefs struggling so much?
I think probably the funds themselves are asking that question. The bottom line is that their NAVs are not increasing significantly. A number of them are fairly close to dividend cuts because dividend cover is quite low. And despite all the hype from government about investing in wind and solar and so forth, the bottom line is that returns for investors in recent years in these funds has not actually been that good. Yes, they've got dividends, but they're looking forward to the NAVs. The NAVs are not increasing, and if your NAVs are not increasing, it's quite difficult to have significant dividend increases.
Yeah, absolutely. So, how have the trading premia or discounts against NAVs fared lately?
Well, they've changed very markedly. Back in 2022, BBGI, which is no longer listed, but that had a premium of around about 25%. We've now got many funds, not so much the infrastructure investment funds, whose discounts are substantial, but not nearly as big as many of the renewable energy funds, where discounts are over 30, 35, in some cases more than 40%. Those are big numbers, and it's very difficult to raise additional funds if you need it against that sort of background.
Yeah, yeah. And what about dividends? Have dividend cuts been widespread in the sector?
Dividend cuts have not been that widespread unless it's some of those funds who are in managed wind down. That's perhaps a rather different scenario. But for the infrastructure investment companies, dividends have gone up in most cases. They're not spectacular. In the case of the renewable energy funds, most of them have managed to increase their dividends, but at a pretty modest level, a couple of percent here or thereabouts. And compare that with some of the dividend increases elsewhere in the market, and they look a little bit thin to say the least.
Okay, nothing to write home about then. Um, okay, so given the various managed wind downs, are investors now losing patience with the sector? How do you think it's being digested?
Well, that's a good point. Back in the early 2020s, the investor appetite was very strong, as we saw with many IPOs at that time. Now, many investors are clearly losing confidence in some of these smaller, less mature, and less financially viable renewable energy funds. Several have gone into managed wind down. Managed wind down means basically you sell all your assets at the best possible price, but with many sellers out there and with assets arguably difficult to sell anywhere near their net asset value, it's actually pretty difficult. So depressing times for the smaller ones who are saying, look, got these assets, please buy them, and we'll return any funds we make from them back to shareholders.
And would you say equity markets are currently closed to the sector?
I wouldn't say for the various 25 companies in the expanded sector that is the case. If you were 3i Infrastructure and you wanted to raise some money on particular terms, you no doubt could do so. But for most of them, they have to accept that equity markets, for the moment, at any rate, maybe 1 year, 2 years, 3 years down the line, actually are effectively closed. I use the phrase ajar. If they come up with a really good launch, there is a possibility. But the reality is, for most of them, they have to increase their borrowing, reduce their costs, or sell surplus assets. Many of them are actually either trying to sell surplus assets, or in some cases, going down the share buyback route. which in the short term has some advantages, but is not really a long-term solution to growing a company.
Okay, and are new investment or asset sales in the ascendancy?
New investment, sadly, is not. Asset sales are. And if you look at the various companies managed wind down, they're trying to sell as many of their assets as they can at the right price. If you are struggling to raise money and you want to expand, well, you can roll over some of their assets. And some of the stronger companies in the renewable energy sector are actually selling assets in the same way that some of the larger infrastructure investment funds have done over the years. 3i Infrastructure, for example, regularly sells particular businesses. They make a nice profit normally, buy another company, make profit on that, and their net asset value increases quite substantially, which it has done in recent years.
Okay, and holistically, what could reinvigorate the sector?
Substantial growth in net asset value. And if you look at the 25 companies, 3i Infrastructure has increased its net asset value by something like 70% since 2018. No other member of the sector anywhere near that. So increasing net asset value would obviously help. At a more macro level, substantial reduction in interest rates will certainly help valuations. But at this particular time, it's quite difficult for the companies. How do you actually expand and raise money against a background of very big net asset value discounts? Interesting times, but there are opportunities. Perhaps the worm eventually will turn.
No, thank you so much, Nigel. Great to see you as always, and thanks for the updates. It's very much appreciated. To our viewers, please don't forget to like and subscribe to our channel. We really appreciate your time. Do share your thoughts in the comments below and hit the like button. Otherwise, we'll see you back here on Hardman Talks next time. Thanks again.